In this video, I'm going to talk a little bit about homeowners insurance policies and what perils are covered. So perhaps I should first start with the definition of peril is going to be some kind of an event or occurrence that's causing some kind of damage. So, think a fire or a situation in which tree limb falls and damages the roof, or maybe a hailstorm, or things of that nature. So those are the kinds of things that are perils. Okay. So for homeowners insurance, which perils are covered depends on the type of policy you have. So first, we can have basic coverage, and this is going to be what's considered to be a named peril policy, and specifically more of a basic named peril policy. And what that means when it's a named peril policy is that the policy is going to name or list which perils it will pay out for. So if it says that it will pay for hail damage and it will pay for a fire, then that's what it's covering. If that's all it lists and you have a water leak that damages your home, sorry, not covered, right? Because it wasn't named. So for the basic coverage kind of a policy, you have to pay attention to which perils are actually named. So what's named matters quite a bit. A broad coverage policy is still a named peril policy, and it's going to cover the basic named perils, but then it's going to add additional perils. So it's basically going to just kind of expand the amount of things that are named that would be covered. And as you'd expect, this is going to be a bit more expensive typically from coverage standpoint. Then we get to the next type of homeowners insurance policy in terms of what it covers, and that's going to be an open coverage policy. An open coverage policy is going to cover anything that's not specifically excluded. So if it's an open coverage policy, it may state that it excludes flood damage. And if that's the only exclusion, well, then that should mean probably with the tornado, you're going to be covered, hailstorm, you ought to be covered, lightning strike, if your house burns down due to a fire, things like that ought to be covered. But if it excludes the flood, well, then if a flood comes along, it's not going to cover that. So for open coverage, it's generally going to cover a lot more, but it is not covering whatever is excluded. Now, within the fact that some of these things are actually covered, you can actually purchase endorsements to cover more things. So, or I should say, sort of add endorsements to the policy, which will come at an added cost. So you are in effect purchasing them. But basically, you can add these endorsements to the policy to increase the coverages and what will be paid for, and that could matter as it relates to perhaps the type of property within the house, like personal property that might be covered. There's some endorsements for that. You could have some other endorsements as well for other types of things. Basically, you could add protection due to what's happening with inflation that would kind of protect the policy for that, and earthquakes, and all various kinds of things. So endorsements are often possible to kind of increase the coverage in various ways. And I'm going to do a video in a little bit that we'll talk about that in more detail. Now, interestingly, flood insurance is often separate. So damage due to an actual flood is typically separate from a standard policy. And the reason for that is flood insurance a flood tends to really kind of mess with the standard insurance model. So if you go all the way back to the basic concept of what insurance is doing and kind of how it works, the whole idea is the insurance company is assessing the probability of damage, charging people premiums related to the probability of events occurring. And so if you take a fire risk, for instance, a small proportion of how homes burn down in any given year. And so if the insurance company sells an insurance policy that's covering fire, their assessment is what proportion of homes are likely to burn down, make sure we charge enough in premiums to cover the losses for the homes that do burn down or incur fire damage, make sure we've charged a bit more than that so we make a little bit of money for all of our time, and also to cover for our risks that things didn't work out the way we thought as an insurance company. And that's basically the model. And so the premiums that are being paid in from some people who do not have a fire actually wind up paying for the damages of somebody who does experience a fire. Well, If you deal with a flood, the problem with a flood is floods often affect very large areas all at once. And so this could lead to substantial amounts of payouts to a whole bunch of policy owners all at once. And so kind of that risk spreading kind of model, that probabilistic model, doesn't work nearly as well when dealing with something like a flood. So flood insurance is often separate. And there's a national flood insurance program. So if you take out a mortgage on a home that is living in a flood-prone area, they may require flood insurance, but it's very possibly something you might have to purchase through the separate national flood insurance program, not through your standard homeowners insurance policy. Basically, due to the fact that there are those risks that don't lend themselves to being insured by a standard insurance kind of a model. Okay, so hopefully that's been helpful. Thank you so much for watching and have a great day.